Matthew, I want to pick up on that point around supply and demand, because as Uber cites issues now, teething issues around the United States, I've got to say I've seen it right here in Europe as well. It's not just restricted to one market. And the problem here is that a moat that we assumed a company like Uber and others have had, because they've had very clean execution on their product since launch, it may not be the same case now as you get frustrated with the product and you start searching for a rival or a competitor. What do you make of the competitive challenge in that moat for some of these companies battling supply issues?
Yeah, well, first of all, thanks for having me back on, guys. I think it's a great question, and one particularly as the world reopens. A lot of companies, even beyond Uber, are facing that challenge and that question, and they're having to pull a bunch of different levers. Whether it be, Uber talked yesterday about looking at incentives to drive new drivers onto the platform, incentive for consumers, or just constantly evolving the consumer proposition. So, I think it's nothing these guys haven't seen before over the last 15 months of constantly evolving their business models. It's just a slightly different challenge. I think the encouraging thing is the consumer demand has really bounced back. The companies that saw benefits over the last 15 months are pivoting their business models and continuing to see strong trends. So overall, as we heard at the conference the last 2 days, there's a pretty buoyant mood within the disruptive tech industry. And I think while there'll be challenges, they're ready to adapt and move forward.
One has to wonder what that means on the margin side, though, Matthew, as you talk about these incentives, because it's not just with Uber and Lyft, it's also over at Amazon, some of these businesses at the coalface of the consumer. Do you think we're going to see these pricing pressures continue, or are they just transitory?
I think they're likely to be transitory. I mean, there's constant pressures. There's pressures in the labor market right now, is being talked about. There's pressures from new competitors coming in, and I think it all comes down to whether you offer the consumer a differentiated proposition. If you've got a Me Too product, you're selling commoditized products online. There's an incredible amount of competition right now. If you can create a competitive moat like Amazon has done with the Prime ecosystem, if you can do it with the likes of Uber and some of their competitors by layering additional services onto a super app type platform, that's how you really can have a differentiated proposition and maintain some pricing power with your consumers.
Matthew, we've got about 270 SPACs at the moment looking for an underlying business to invest in. But as I read the Wall Street Journal, they're suggesting that a lot of startups now are pretty wary about going the SPAC route. One, why is that? And two, do you think that the SPAC phenomena has topped out here, given that the majority of SPACs that have gone public are now, well below their highs?
Yeah, I mean, SPACs was kind of the first, second, and third topic of every conversation for the first 3 months of this year, and it certainly has turned. We're firmly of the view that SPACs are here to stay. It's just an alternative way for companies to go public. There is certainly a huge backlog out there of SPACs that have raised money. There's SPACs that have announced a deal but haven't completed the transaction yet. And there's a little bit of a digestion phase, we think, right now, where some of the deals that are just in process, the pipe that has been announced, needs to get out of the system. We need to see how those companies trade when the merger is completed, and then that will open up the opportunity to do more SPAC transactions. The key thing, though, is a SPAC is at the end of the day just another way of going public. The SPAC transaction works with the pipe coming in, which is the institutional investors investing in, and so the institutional investors at the end of the day are going to set whether these SPACs are able to de-SPAC into a target. The valuations has to work for the public markets, not just for the SPAC. And I think that's something we're seeing in the conversations the SPACs are having today. They're being much more constructive on valuation, and those trends are really going to be reflected in the second half. So we think the SPAC activity will be lower as far as an issuance standpoint, but you're going to continue to see a lot of de-SPACing transactions through the rest of the year.